Where should you invest your first $500 in 2025? You've worked hard, you've saved up, and now you're ready to make that money work for you. But with inflation constantly reducing your cash's purchasing power, just letting it sit isn't an option. Investing has become a necessity, and that $500 is the perfect seed for your financial future. Forget confusing jargon and risky hot stocks. This video is your direct, step-by-step roadmap to investing with confidence. The most important decision is the one you've already made, to get started. So, let's build your personal investing framework from the ground up. First, we'll define your risk tolerance. Are you aiming for slow and steady growth, or are you comfortable with more volatility for higher returns? Next, we'll demystify the best investment vehicles for a beginner. We'll focus on powerful, accessible options like index funds and ETFs, which let you own a piece of hundreds of companies with a single purchase. We'll show you exactly how to choose and open a brokerage account, set up automatic deposits for consistent growth, and confidently place your very first trade. And is $500 really enough to make a difference? The answer is a definitive yes, thanks to the power of compound interest. Think of your investment as a small snowball at the top of a long hill. As it rolls, it picks up more snow, growing bigger and faster. That's your money, earning returns on its own returns, creating a cycle of exponential growth. We'll show you how this simple principle can turn your $500 into a life-changing sum over time. By the end of this video, you won't just have a list of options. You will understand your investing, and you'll have the foundational knowledge to take control of your financial destiny. The path to financial independence starts now. Let's find the perfect home for your first $500. Where should you put your money in 2025? Aim for long-term growth with index funds. Before you invest a single dollar, the first and most important step is to understand your personal risk tolerance. This is how you emotionally handle the market's ups and downs. Can you sleep soundly if your portfolio drops 15%, or would you panic and sell? Your answer is the core of your investment personality. Generally, investors fall into one of three categories: conservative, moderate, or aggressive. Let's quickly break down what each one means so you can find yours. First, the conservative investor. Your primary goal is capital preservation. You want to avoid losing money above all else. You prefer lower risk investments like bonds and high dividend stocks for steady, modest returns, and the thought of a market downturn makes you anxious. Next, the moderate investor. You're willing to take on some risk for higher long-term growth, but you want a balanced portfolio to cushion against major losses. You're comfortable riding out market fluctuations and often use diversified index funds, like an S&P 500 ETF, as the core of your strategy. Finally, the aggressive investor. You're hunting for maximum returns and are prepared to take on substantial risk to get them, viewing market downturns as buying opportunities. You're comfortable with huge swings in value for a chance at explosive growth, often using individual growth stocks or even crypto. So, which one are you? Be honest with yourself. How would you react if your investment lost 30% of its value? Answering this question is your first step. By aligning your investments with your personal risk tolerance, you create a strategy you can stick with through good times and bad, which is the ultimate key to success. Once you know your type, you're ready for the next step. Welcome to the first and most crucial step in your investment journey, building a solid foundation. Before we dream of hitting home runs, we need to construct the bedrock upon which all future financial success will stand. This first portfolio is designed for safety, stability, and simplicity. It's the strategy recommended by legendary investors like Warren Buffett for the vast majority of people who want to build wealth steadily over time without becoming full-time stock market analysts. The goal here isn't to get rich overnight, it's to ensure you get rich slowly and surely. The cornerstone of this conservative approach is the diversified index fund, specifically an S&P 500 ETF. Let's break that down. Think of the S&P 500 as a curated shopping list of the 500 largest and most influential public companies in the United States. An index fund is simply a basket that buys and holds shares in all 500 of those companies. When you buy a single share of this fund, you instantly become a part owner in a massive, diversified slice of the entire US economy. This is the magic of diversification. If one company has a bad quarter, there are 499 others to help balance out your investment. You're no longer betting on the fate of a single business. You're betting on the long-term growth and innovation of the market as a whole. The ETF part, which stands for Exchange Traded Fund, just means this basket of stocks can be bought and sold on the stock market as easily as a single share of Apple or Tesla. This accessibility makes it incredibly simple to get started. So how do you put this into practice? The strategy is called dollar cost averaging. Instead of trying to time the market by investing a large sum at the perfect moment, a near impossible task, you commit to investing a fixed amount of money at regular intervals, say $200 on the 15th of every month. When the market is down, your fixed amount buys more shares. When it's up, it buys fewer. Over time, this approach smooths out the volatile ups and downs and builds a powerful, disciplined investing habit. Historically, the S&P 500 has delivered an average annual return of around 10% over the long run. While past performance never guarantees future results, it demonstrates the powerful engine for wealth creation you're tapping into. This strategy isn't about frantic trading or chasing hype. It's about patience, discipline, and trusting in the proven long-term growth of the market. By starting with an S&P 500 index fund, you're laying a foundation so strong and reliable that it can support all your future financial goals. This is the intelligent, stress-free starting point every new investor needs to master. For more growth, a mix of index funds, stocks, and crypto. For more risk, tech stocks and crypto. But invest wisely. So how do you actually invest that $500 today? The trick isn't timing the market, it's time in the market. Don't take out small gains, reinvest them. Compound growth is your superpower. This is how small amounts become big amounts. Where to invest in 2025? Consider diversified index funds.